today we are joined by the management of Mahindra Finance, and we have Ramesh Iyer, who's the MD and Vice Chairman of Mahindra Finance. Thank you so much, Mr. Iyer, for joining in with us on ET Now today. And firstly, I want to start by talking about the improvement that you've seen coming in the asset quality, as well as the low credit cost, also something that has aided the bottom line of your numbers. Now, but your interest income, when I'm looking in those terms, and your operating profit have remained quite subdued. So what is the reason behind the same? What is the divide, the gap that we're seeing there?
So if you look at on the interest, there are 2 or 3 things that one should note very clearly. One, of course, our collections are far higher than the disbursements that was there for the last 1 or 2 years. And therefore, there has been the asset degrowth, which we saw the previous few quarters. Now it's caught up again. So that's one of the reasons. And the second reason is the product mix has definitely undergone some change, which is we are getting more traction from cars, we are getting more traction from UV as against tractors or a pre-owned vehicle, which was was happening earlier, and they come at different yield levels. That's also got corrected now. And the third is there has been a one-time kind of additional provision that we have made for about 150 crores of interest refund for customers based on the schemes, and that's a one-time impact. So these are the 3, but I think now that the asset is growing and the disbursements are growing, I think this will get pretty fast corrected.
Right, Mr. Iyer, but in terms of write-offs, they have remained elevated in Q4 and also in FY22 as a whole when you look at it. So how should one actually look at this going forward? Will they remain elevated, or is it possible, or possibilities of write-backs are there here?
So clearly, we have changed our write-off policy. We have become a little more aggressive. Having looked at what the customers are going through, certain segments went through more difficulty, and it's more asked by the customer to say, we would want to come out of this and therefore settle our loans, etc. So we have taken that aggressive stand, and in this quarter, we have also made provisions, 100% provision for 18 plus outstanding. I don't think going forward, this is going to have a major impact because the cleaning up has been already done. So one should look at it from the book has been decently cleaned up for delinquencies by the customer, and we don't see this a repeat.
Okay, and Mr. Iyer, M&M Finance has actually remains amongst the only few companies that have not provided for RBI's NPL norms now as the timelines were extended. But according to your internal estimates, what would be the impact of the same? Also, could you give us an update on the restructured book size as well?
So if you recall, even when this announcement had come sometime in November, we had said that the lowest that would be required was about 500 crore and the highest that we may be required to provide was about 1500 crore. We substantially moved from that position. We have seen improvement to collections, asset quality, etc. And that we have time up to the third quarter of this year. We don't see there is going to be any major impact coming from this. We are very conscious of this, and we may not be required to make any big additional provision is our understanding as we see things improving on the ground. So far as the restructured books are concerned, again, these are good customers whom we had given time, and we had done about restructuring for about 4,000 odd crore when the restructuring was announced. And we are already seeing more than 30-35% of the customers are in zero DPD, which means they have become already regular by making all their payments. So again, we don't see any issue coming from that side. Clearly, the collections are holding up, and these customers are also repaying well on time.
Mr. Iyer, inflation is one pinch point for everyone and every sector. So have you actually seen any impact of this rising inflation coming in on your rural demand? Are collections seeing any sort of a delay?
In fact, the way one should look at it is that if the inflation was to go up, the ultimate customer does benefit because the crop prices are going up. And that's one of the direction for the inflation. And clearly we see their cash flows improve out of this. But the current pressure that we see on our customers are really from the fuel price increase. And therefore, the cost of operation for these people do definitely go up. But again, on that front, you would see very soon the freight rates going up or even the passenger fares going up. because now that everything has opened up, people were first wanting to come back to activity before they can talk of price increase. Now that the activities are stabilizing and are really going pre-COVID levels, I'm reasonably sure that the freight rates as well as the passengers fare will go up, and therefore the ultimate consumer will pay a little for that.
Mr. Iyer, you have actually outlined your vision for 2025, your aim to double your AUM supported by the new business segments. Now, is this vision a bit stretched? And given the fact that the new business lines are highly competitive, will that increase your expenses? What would be the impact actually of the same on your profitability?
So clearly, one should understand that the last 2 or 3 years have been a very high pressure for rural, and therefore the base is not very high. If we were to have a normal 3 year, 2025 vision would have looked like a 40% growth and not doubling of the balance sheet. So to some extent, it's covering up of the past that is happening through this. Therefore, there is a base effect clearly. The second is that, as I said, the next from 22 to 25 will be a real growth story for rural, because the infrastructure spent in rural is going to be very, very high. We already see road projects going big time. The asset absorption, labor absorption is very good. Mining opening up, coal excavation will start. I think put all this together, clearly infra story is opening up. The monsoons have been good, yields have been good, support price is good. Therefore, the farm cash flow is good. The third economic activity there from where our customers start making their money is all about tourism, temple tourism, people movement, schools operations. And these are the segments I've been talking about, which are under tremendous pressure the last 1 or 2 years. All of that are opening up. So I don't think we have any doubts in our mind that what we are set out for 2025 is a very, very difficult task. Of course, it is a stretch, and it's all about execution. We are putting in people in place. We are putting in all the required technology support as well as the digital support in place. People capabilities are being built. So I think we are completely getting ready for executing it and achieving it. I think that's not the challenge that we are clearly looking at. And if this was to happen, to your question on profitability, on the current balance sheet, you have seen once the asset quality starts to correct what kind of profitability this business can return. We've already reached a 1.4, 1.5% ROA, and we have said in the document that our aim is to reach a 2.5% ROA. That's also doable with the balance sheet growth.
Okay, Mr. Iyer, thank you so much for joining in with us and giving us all the insights about the company and the Q4 earnings.